I'm Kylie Barnes. I'm the relationship manager at EasyEquities. And today you guys are going on a trip around the world with me and a few other cool people, but mostly me. Because today we are going to be talking about the Satrix MSCI World ETF. I'm so excited for this discussion. Joining me today are two absolute legends. The first one is Kingsley Williams, who is the Chief Investment Officer at Satrix. How's that for a title, guys? Kingsley is going to be joining us today to share a wealth of information with us about this ETF and share some of his expertise with us. So that's very cool. And the other legend who's joining us is Teaser from Chats with Teaser. This little South African YouTuber is actually living in China. So I thought, who more fitting to join the conversation than one of our own EasyEquities community who clearly thinks super globally. So I'm really excited to have you guys here. Thank you so much for joining us. And let's get into it. Let's talk ETFs and the MSCI world. And I think I really want to start with you, Teaser. I want everyone to meet you and see how amazing you are. You are such a little spark of energy. And I think maybe if you could just talk a little bit about your journey as an investor. How did you get here? What made you want to start investing? And how did you discover ETFs of all things?
Thank you so much, Carly. And thank you everyone for joining today's webinar. I am so excited about it. Anything that involves investing gets me really, really excited. So, I would say my journey with investing really started with my TFSA. I always used to hear tax-free savings account. You need to have a tax-free savings account. And I opened one with a particular TFSA provider because there's so many in the market. And I had it for about a year. And then I was like, wait, hold on. What's so special about this TFSA account if it doesn't really make you that much money? So after doing some research, I realized that my TFSA was not invested in anything particularly that I had chosen or had any knowledge of its performance for me to understand that, well, it's not making that much money because I'm not even aware of the investments and having read minimum disclosure documents or anything like that. So I withdrew my money. I didn't even transfer. I withdrew the money, of which that was a terrible mistake. And then I moved it over to EasyEquities. This was under lockdown last year during COVID, when you're now thinking about your life. You're thinking about your life. You're thinking about everything because you can't go anywhere, right? So I was like, let me get my finances in order. I didn't know what to do, how to start. But as soon as I hit the EasyEquities website, I was like, there's a wealth of information out here that I didn't even know about that can help me on this journey. And I was like, oh, there we go. So I put my money into my EasyEquities account, but I won't lie, it did take me some time to start buying ETFs because even that I didn't really understand. I couldn't really get to grips with how does this work. But like I said,
I'm going to stop you there because I think there's probably so many people out there right now listening to us going, what is a tax-free savings account? What is that even? And I think it's a really good time to kind of make mention and talk about tax-free savings accounts because I'm a huge fan. So for anyone who's joining us who hasn't heard about what a tax-free savings account is, it's exactly what it sounds like. It's a way for you to invest your money without paying tax. Now, there's certain things that you've got to kind of stick to, but how it came about was South African government looked at us South Africans and they thought, you guys need some help with your savings behavior because you're not so good at it. So we're going to give you this break. We're going to let you invest up to 36,000 Rand a year, tax-free. And because they sort of wanted to give a degree of protection or to mitigate risk, they said, okay, you can only invest in certain things in your tax-free savings account. They're called collective investment schemes. And that's really to make sure that you're diversified, that you lower your risk. And ETFs, exchange traded funds, happen to be exactly those things. So ETFs are things that you invest in inside your tax-free savings account, and your tax-free savings account is a way for you to invest tax-free. You don't pay tax on the dividends you receive, on any interest you earn, or on the capital gains of your investment, which is just how much your investment grows over time. And to your point, Teaser, I mean, if you just had an account with money sitting in there doing nothing, you're wasting such an opportunity. You could be investing that money in something awesome, like an ETF that fits your particular investment style, and then that money has the opportunity to grow and do things for you. So let's pick up from there. How did you get to looking at the Satrix MSCI World in your portfolio? What attracted you to that particular ETF?
Well, after crossing the hurdle of understanding what ETFs were, and I have to thank the ETFs EasyEquities page. It's literally etfs.easyequities.co.za. I love that page. And the first thing that I saw when I went onto the page was that there were ETFs that were listed according to how well they're performing, ETFs that were listed according to how popular they were. And I was like, okay, maybe I'll pick out a few that are performing well and a few that are popular. That's how I sort of started. And then I ended up with a whole bunch of ETFs in my TFSA. And after some time, I decided, no, I want to scale it down because there's too many. There's like a lot happening. I know we need to diversify, but that was not diversification. It was just me being the shopaholic self. So then I saw the MSCI World ETF, of which I could look at the minimum disclosure document as well as the fun fact sheet. And I realized, hey, there are companies in this ETF that I cannot afford to invest in individually that are really, really big and are performing really well. And all of these affect this whole ETF. Then why not go with this ETF then? And these companies are companies that we use their products every single day. We hear about them all the time. And I was like, well, then my money best start performing in these particular products that I'm consuming anyway. I best be making money from that too.
So tell us about a couple of those companies. Which ones stood out for you? I know there's a little bit of Tesla in there. I know there's some PayPal. What other ones kind of stood out for you?
Apple stood out, and it has the highest weighting. So when you look at the companies that are in that ETF, Apple is the first one you'll see because it has the highest weighting. And Microsoft, Google, I need to think at the top of my head. Exactly. And honestly, with the importance of diversification, I felt that this ETF literally simplifies it for me. We always hear that we need to diversify and invest in different industries. And I realized that with these companies that are in this ETF, of which we'll hear more about that from the Satrix expert, but I felt that this ETF does that for me, just simplifies it. It just makes me sleep better at night.
So a couple of things there that you said that I really want to unpack a little bit for people. So there may be people with us today going, this is the first time I'm hearing about an exchange traded fund. What is an exchange traded fund? So I'm going to give you guys a really simple explanation. An exchange traded fund is basically something that you can invest in that contains a collection of different companies, but you invest in it as one thing. So it's one transaction, but you get exposure to all of these different companies. And different ETFs follow different themes. So today we're talking about the MSCI World, which, as you probably guessed by now, has companies from different countries all over the world, which, as you said, gives you great diversification. And that's the other thing I wanted to touch on briefly before we chat to Kingsley, who's going to get into it with us. Diversification is an investing principle that means you're spreading your risk and your opportunity out. So instead of putting all your eggs in one basket, all your money into one single share, you are spreading it through a few different companies, maybe a few different industries, maybe even a few different countries, as what we're seeing here. And so that really helps you manage some of the risk that is always associated with investing. So just to kind of school you up on some of those terms. And now I kind of want to get into this, Kingsley. I want to chat about the MSCI World specifically. Do you know how many companies there actually are inside it, and from which countries? Let's talk about what that actually looks like.
Cool, thanks, Carly, and great to be chatting with you and Tisa today. You know, I always maintain that a picture's worth 1,000 words. So rather than you hearing me ramble on and talk about numbers, which might go in one ear and out the other, let me share a slide with you and the audience, and we can talk to that together.
While you're bringing that up, Kingsley, I just wanted to kind of let everyone know who's joining us today. If you guys have questions and you want to make sure you don't forget what you want to ask, please drop us a question in the section that says Q&A, and we'll get to that at the end of the session. So I'm sure a couple of you are thinking, okay, I definitely want to ask about this or that. You're more than welcome to pop that in the Q&A section now. And as soon as we finished our general discussion, we'll jump on there and make sure we get to everything you need answers on. Cool.
Great.
I can see your screen here.
Awesome. So I want to just contextualize how MSCI World fits into the global investing landscape. You've probably heard of a number of indices that ETFs track. Last week, we heard about the top 40, which offers you exposure to the 40 largest companies on the JSE, so locally listed equities in South Africa. MSCI World is a global or developed market index, so tracking companies that are listed in developed markets around the world. So your largest developed market would be the US, and you'd have the UK and most of Europe, Japan, various developed market economies around the world, so-called first world countries. And you can see here on this slide that there are just short of 1,600 companies that make up MSCI World. So orders of magnitude larger than what you get on the JSE. In fact, I want to just show you how big MSCI World is in terms of the size of the companies that it represents versus our local market. But before I get to that, I need to just show you some of the other indices that you might be familiar with. So S&P 500, that gives you exposure to just the US and typically just to the large companies within the US. So you'll see with MSCI World, it's got exposure to both large and medium-sized companies. So not just the mega caps and the largest companies within each market, but also the next tier down from that.
Which is nice because it gives you other opportunities. You know, I think people just look at sort of the big names and they go for those, but there's actually probably some hidden gems that are not maybe as big and established, but could still offer you benefits. So that's quite nice that there's a mix.
Growth is not infinite. So, you know, there's a limit to growth. There's only a finite population of people to sell things to. So that's really where the growth opportunity sits with many companies. Is smaller companies have the potential to grow to larger companies, whereas the growth prospects of larger companies might not be as attractive. Another well-known index is the NASDAQ 100, also operating in the large cap space, but just giving you exposure to stocks listed on the NASDAQ exchange within the US. So it's like a subset of the US. And NASDAQ's really synonymous with innovation, technology, new world type companies. So a lot of the tech names that Tisa was mentioning earlier would typically be listed on the NASDAQ exchange. So you're really a tech play if you want to think of it from that perspective. Nice. So that's the developed universe. Then there's the emerging markets universe, and I know we've got another webinar set up for 2 weeks' time to talk about that in more detail. So I'm not going to share too much on that now. Within that, your largest country is China, and then there's South Africa. 140 stocks relative to the almost 1,600 within MSCI World. And if you look at the size of South Africa within this ACWI universe, which is developed and emerging together, makes up about 0.5%. So that just gives you a sense as to how large the global investment opportunity set is relative to what we have access to on the JSE.
Yeah, and then you get that diversification. So, I mean, you can have some South African ETFs in your portfolio and this, and then you're sort of able to reap the benefits of both potentially. And I think it would be great to actually talk a little bit more about the currency, because what's amazing about an ETF like this is it's an international ETF, but you can still invest in it with Rand and at the same time get the benefits of the different currency that sit within it. That's a very long-winded way of explaining, but yeah, I think that's something a lot of people don't think about.
Yeah, so I mean, there's so much to unpack with what you get when you invest in an offshore strategy. And I just wanted to make one other point about diversifying amongst particularly global ETFs, is that, you know, you do have an element of having exposure to the same things. I think Tisa was touching on that with having multiple ETFs within her tax-free savings account. You can see that within MSCI World, you have exposure to the companies that are in the S&P 500 because they're US companies which are included within MSCI World. You've also got exposure to the NASDAQ 100 companies. All that will happen, all that will be different is the weighting to those companies, but I'll touch on that a bit later on. So coming back to this chart, this is actually an interesting timeline because it kind of captures most of my working career. I kind of started working back in 2000, and I'm not sure if the listeners remember the tech bubble or were around for the tech bubble, but that was a significant moment in history. Arguably, we're living through that at the moment with a lot of tech companies being very prominent. But you know, there were some crazy stories of companies listing on the exchange. They made no profits whatsoever, but they were completely speculative. Pets.com comes to mind, you know, playing on the whole pet craze and being able to sell things to owners of pets. But, you know, needless to say, that whole tech bubble unraveled. And the following year, I was actually in New York at the time when that happened. And the following year, I was in London. And of course, we had 9/11, which obviously created a huge crisis for markets globally. And they, you know, markets continued to unravel for about another year after 9/11. That was September 2001, bottoming out at around September 2002. So you can see that over here on this chart.
So Kingsley, what we're looking at on this chart is actually, you know, a representation of the economic climate of the world for those 20 odd years.
Exactly, exactly. And what I want to show you with this chart, it's important to know what you're looking at when you look at a chart like this. This is what they call a log chart. So you'll see these grid lines here. It's 100, 200, 400, 800, 1600. So what that means is when you cross from one grid line to the next, that represents 100% return, a doubling of your investment value. But similarly, if you go from one grid line down to the next, that represents a halving of your investment value, 50% loss. So if we go back to that tech bubble and the subsequent crash, you know, the MSCI World lost about almost half its value from here down to here. And it took about 3.5 years for it to recoup those losses and get back to the previous highs that it had achieved. And I think that talks a lot about the risk appetite that investors need to have when investing in equities. It is very much a long-term game. So, you know, if you're planning on putting your money there and taking it out in a year's time, it might not be the right investment because you really want to be investing in equities for the medium to the long term. So at least 5 years. And you can see that with the cycles that the markets go through. Here's the global financial crisis where markets also lost in excess of 50% of their value and took almost 4 years or in excess of 4 years to recover those losses. And then more recently, we've had the COVID crash, which you can see over there. One of the fastest sell-offs that we've had in history, but also one of the fastest recoveries we've had. And you can see looking at this long-term chart, it hardly even registers as a crisis. But when you're living through it, it's a huge crisis. Your value has been decimated. And the big temptation that we have as investors, and this is one of the big behavioral anomalies that plagues investors, is that when the chips are down and the losses are showing on your portfolio, that's when we're tempted to sell, which is absolutely the worst thing to do if you're investing in a risky strategy like this, because crises have happened in the past and crises will happen again in the future. And markets will go through those cycles of losing a significant portion of their value and then recovering. And the problem is if we as investors sell when the chips are down, we miss out on the subsequent recovery, because it's very difficult to know when to get back in.
That's a really, really good way of putting it. And I think it is important to keep that in mind. You know, we're talking here about investing. We're talking about growing your wealth, which is a very different thing to something like trading, which is where you are wanting those ups and downs. You're wanting to, you know, reap the rewards of kind of investing in that way. But this is about wealth creation. And as you said, it's so important to have that long-term point of view in mind. And a chart like this just really, you know, paints the picture.
Exactly. So I want to just put MSCI World in context, because we have this thing in investing known as home bias, which means that investors tend to be more comfortable and tend to invest more of their savings and investments locally, i.e. on the JSE. So Niku last week spoke about the top 40 index. I'm showing you the all share index here in green. And the top 40 is about 88% of the all share index. So this all share index also has mid and small cap companies, whereas the top 40 is just the large cap, but they're going to be very similar through time. And importantly, these two charts are both shown in dollar terms, so in hard currency terms. So it's important when you show a chart that you comparing like with like. If you're looking at something in rands, everything must be in rands. In this case, I'm looking.
I was going to say apples with apples, but I don't think you can really compare Apple with anything here in South Africa. So
everything to US dollar terms. And
Kingsley, we're losing you a bit there. Are you back?
Yes, I can hear you now. Thanks. So what's interesting with this chart is that you'll notice that our local market over this time period has performed even better than MSCI World.
Wow.
I hope I'm still coming through.
Yes.
And that's very interesting, because you know, this is always a surprising result when you look at this, because we think that a lot of the growth is to be found offshore and diversifying away from the rand, which, you know, is a depreciating currency. But you can see here over this long period of time that, you know, our local market has outstripped the performance of world markets globally by a long margin. But importantly, you need to look at where that's happened. And you can see that by the slope of this chart, that a lot of that outperformance occurred pre-global financial crisis. If you look at this point over here, where this is post the global financial crisis, you can see both charts are sort of on their respective grid lines, MSCI World at 100 and our local market at 400. You can see that our local market has, in hard currency terms, just about doubled, because it's moved up to the next grid line, whereas MSCI World has quadrupled, right? It's gone from 100 to 400. So there has been a lot more growth from developed markets since the global financial crisis. And this, you know, the US in particular has been at the forefront of that growth, particularly with quantitative easing and the reduction of interest rates. Developed markets and the US in particular have benefited a lot from that.
That's so interesting.
So, yeah, so the last little nugget I want to share is what the currency then does in relation to what these markets are doing. So this gray line that you should hopefully be able to see is what our rand has done versus the dollar. So when you you mentioned it earlier, when you invest in a global ETF on the JSE, you're getting not only the performance of MSCI World, if you're tracking the Satrix World ETF in dollars, which is what this blue line represents, you're also getting the performance of what the rand does versus the dollar. And I'll show you what that looks like in a moment. But this is what our currency has done through time. And there's an interesting pattern that you can pick up here. When equity markets go through periods of crisis, as they did here with the dot-com crash and 9/11, again through the global financial crisis, and then again through the COVID correction, see how the rand spikes. And this is actually the rand weakening, right? The dollar strengthens and the rand weakens during those periods of crises. But then something interesting also happens. Post that crisis, the rand then strengthens again. And that's happened here. It's happened post the global financial crisis, and it has happened very strongly post the COVID correction we saw last year.
Okay. So then how does that impact investors? So if I was to be holding the MSCI World, are you saying that even though maybe at certain points the rand was taking a knock, I would have been realizing sort of, if I could say, like offsetting that knock in my MSCI World investment, because that strength of the US dollar would have been pulling that up a little bit more?
Exactly. So let me show you what that looks like. So I'm just going to move that chart in dollars to the left and then show you what your performance is going to be like in rand terms for both our local market, which is what we normally refer to the performance of the JSE in rand terms. But now I'm looking at MSCI World also in rand terms. So it's on the same apples for apples basis. And you can see here that, you know, there was far less of what we call a drawdown or loss of value in the MSCI World during the, during the global financial crisis, because the rand softened the blow, because it also weakened, or put it differently, the dollar strengthened during that period. So in rand terms, your MSCI World portfolio was protected from, it would have suffered losses, but not to the same degree as would have been the case if you were, looking at it from a dollar perspective. And then, have a look at the COVID correction that we had last year. I mean, the MSCI World almost went up, even though in dollar terms it went down. And that's because the rand weakened more than, the rand weakened more, the dollar strengthened more relative to the rand than MSCI World weakened. So then you actually insulated your portfolio from that crisis by having exposure to MSCI World in rand terms. And the beauty of sort of looking at this pattern, and I guess, in the interests of, making sure we don't guarantee anything, because there's no guarantee in investing in markets. But the interesting thing that you can do with knowing this is that when the rand strengthens, that creates a great opportunity to use that rand strength, like we've got at the moment, to take more offshore exposure, because now offshore markets are relatively cheaper because the rand is strong. So that's a great time to be investing offshore. The worst time to be investing offshore is probably when the rand's at its weakest, because that's when offshore markets are their most expensive. But again, that talks again to that human behavior, that we tend to chase things that have performed well, but that might be the wrong time to invest in something, particularly, if you want to get in at the right time.
Sure. It's so interesting because there's all these different factors to consider. I mean, Teaser, I don't know if you are someone that looks at charts and graphs when you're making your decisions, or not. Everyone has their own way of kind of deciding when is right for them and what is right for them. I know for myself, I will look at a company's sort of fundamentals. What is the leadership like? What is their vision? Because I know I'm in it for 10 years. I'm in it for such a long time. But that's what's most important to me. And I accept that along the way, there's definitely going to be ups and downs, but it doesn't bother me because I know I'm in it for the long haul. So, I mean, it's just interesting to see how you can gather all these little bits of information to really help you make that decision. So I think we need to start wrapping things up, but I want to take a look at what's inside this ETF, because there's lots of really exciting companies in there. Do you have can you share with us a bit more about some of the companies that make up this ETF?
Yeah, absolutely. So these are the top 20 companies within MSCI World. And just to reiterate the point I mentioned earlier, that there's overlap between other indices because MSCI World represents the full developed market universe. So I've also put S&P 500 here. You'll see it doesn't have Nestle in there because that's a Swiss company, but it has all the US companies. And because it's a more concentrated universe, it has a higher weight to those US companies. You'll see the weight of the S&P 500 is higher than the equivalent weight within MSCI World. And then similarly, NASDAQ will have an even higher weight because that's an even smaller universe. But again, it doesn't include all the US companies because it's only going to include those listed on the NASDAQ exchange. And you'll see most of the tech names at the top of that NASDAQ 100 list. So what I found interesting about this, this slide, Carly, is that if I run through this list of company names, there's probably a handful, 5, maybe 6, which I'm not obviously aware of having dealt with or purchased their products or purchased their services. But I certainly, utilize or know of Apple, Microsoft we use on a daily basis. We shop from Amazon, Facebook. Even if you're not a Facebook user, if you're using WhatsApp, you're using their products.
They're everywhere.
Exactly. Tesla, we know. So most of these companies we're interacting with. And I think that tells you something interesting, that even though they are US companies, according to the way MSCI have classified them and where they're listed and incorporated, the reality is these are global companies servicing most people across the world. And this talks to why they're so big. And you can see that with their market capitalization. This is just a representation of how big they are. That's why they're so big, because they're servicing the global human population, selling their products and services to all of us. So even though they're listed in the US, they're actually providing exposure to the global economy and whatever their products and services are.
Well, I think that's awesome. Yeah, there's a lot of companies in there that I recognize. I want to chat to Teaser quickly and see what her thoughts are. Now that we've kind of got a little bit more background on the MSCI World, Teaser, tell me, you said you had way too many ETFs in your TFSA, and then went through an exercise of kind of scaling down. How many do you have in your TFSA now?
Thank you so much, Kingsley, for that presentation. I thoroughly enjoyed it, and I was seriously taking notes because I learned so much, especially about looking at graphs. Because every single time I buy an ETF on EasyEquities, I always look at the graph, 1 month performance, 3 months, 6 months, and maximum. So thank you, EasyEquities, for having those graphs. I like line graphs, but Kingsley really explained it in a way that I'm probably not even fully understanding it when I see it. I'm like, is it tending upwards? Well, it's tending upwards, with a few drops here and there. So I'm like, I think I can invest in this ETF. So right now, I think I have about 11, but I had so many before. I had 18 or 17. So I'm scaling it down, but I'm also a bit scared to just sell off things and affect my portfolio overall. I actually wanted to ask Kingsley about that. When you spoke about the NASDAQ 100, right? And how it's in that large cap space, and some of the companies that are within that ETF are actually found in the MSCI World. So if I have the NASDAQ 100, the MSCI Emerging Markets, and I also have the MSCI World ETF, should I maybe sell off the other two and keep the MSCI World? Or should I just hang into all of them?
Not necessarily. If you're, the term they use, bullish, if you like the whole technology theme and you think that's going to continue and you want that to play a role in your portfolio, sure, you do get exposure to that within MSCI World already, because those companies are already the largest companies within MSCI World. But if you particularly like that theme, then there's no harm in adding NASDAQ to your broad market exposure. But I always like to say to investors, start with getting the full universe so that you've got that broadly diversified base, and then start being a little bit more selective on which themes or trends you want to take advantage of in your portfolio. And NASDAQ 100 certainly gives you exposure to the tech and the growth theme, along with obviously diversifying away out of South Africa. In fact, it's interesting, in South Africa, our largest company is also basically a tech company. Naspers gives you exposure to Tencent. I think you're in China, Tisa, so you would know Tencent well.
Yes.
But the point is, it's one company, right? And anything could happen with one company. We know there's talks about regulations, increased regulation on a company like Tencent, and that could have an impact on Naspers on the JSE. So having exposure to an ETF like NASDAQ 100, which gives you very broad exposure to a lot of different tech plays, that's not a bad thing to do within your portfolio if you like that tech theme.
I definitely love the tech theme, and thank you, Kingsley, for explaining that. So I'll hang on to them, I'll keep them, but had I watched this webinar before starting to invest, I probably would have just stuck to the MSCI World, because I've got so many ETFs in my TFSA.
Guys, I'm just putting it out there. If anyone's got questions, please drop them in the Q&A. We've got a couple of minutes left where we can kind of address anything specific that you're wanting to talk about. So we've got one here asking, in your tax-free savings account, how often should you or shouldn't you be tweaking that portfolio? Because we know with investing, obviously, every time you buy or sell something, there are costs associated to that. So when you're buying something, you're paying brokerage on it, and you do the same when you're selling. And so, there's a balance between how much and how often you're doing that, but also, like, for example, recently, the Satrix MSCI China listed, and I thought that was, a really great opportunity. And so I added that to my portfolio, even though I'm quite happy with where my portfolio is at. So I don't know, Kingsley, are there best practices when it comes to buying and selling in your tax-free savings account, and what you should be aware of, how often you do that?
Yeah, different investors have got different approaches to the way they want to manage their portfolios. The approach that I tend to follow is one more of buying and holding for the long term. It avoids those transaction costs. It avoids tax implications. That wouldn't really apply within a TFSA account, but outside of a TFSA account, there would be tax implications. So I think the opportunity, if you, from my perspective, where I adopt more of a buy and hold approach, it would be to try and keep your strategy going for the long term. So decide on what the appropriate strategy is to match what you're trying to achieve. Of course, your life circumstances change, and those would be good opportunities to say revisit whether the structure of your portfolio is correct for what you're now trying to achieve with it. But yeah, there are other investors that tend to be more active in the way that they manage their investments and trade more often, but that really depends on what the investment approach is that investors are using.
And something else that you made me think of now, yeah, life circumstances do change. And I think we all in our hearts, it's the last resort to have to, sell off some of our investments if we really need the cash. But in the case of a tax-free savings account, that is one of the benefits, is that it's quite a flexible account in that if you did really need the cash, you would actually be able to withdraw it out of your tax-free savings account. Whereas something like a retirement annuity or other sort of savings vehicles, it's quite difficult to just access your money. You don't always have access to it, and there can be penalties associated with withdrawing. So I think a tax-free savings account, if that's what you are looking for as an investor, is a little bit of flexibility it's another one of those benefits if that's what you're looking for. We've got another question here asking, do I get distributions paid to me from the Satrix MSCI World? And maybe what the question is more about dividends. Is this an ETF that pays dividends, or if a company in that ETF pays dividends, do you reap the benefits of it?
Yeah, so a little bit of that's a great question, and I'm going to have to answer it in two parts. So the first part is the companies within MSCI World. Most of them, or a big proportion of them, would pay dividends, but the nature of the Satrix ETF is that those dividends are automatically reinvested for you. So the ETF will not pay out any distributions to investors, because all of those dividends of the underlying companies that pay dividends automatically gets reinvested. And that's another thing which we haven't really touched on today, Kylie, but it's an important point to highlight, is that the indices and the performance of those indices that I've shown you are what we call total return indices. So they represent the dividends having been reinvested. So not just the price movements, but also the dividends that you receive from those companies being reinvested back into the index or into the fund tracking that index. And over the long term, your dividends are going to play a significant role in the overall return that you experience. So the fact that those dividends are automatically reinvested for you means that you are, again, putting the odds in your favor to achieve higher returns over the long term, rather than you having to manually do that, or be tempted to perhaps take those distributions and use them for something else.
But luckily, we are going to be talking about an ETF that does do dividend payouts. I think that's our next webinar, which is happening next week. So if anyone's interested in ETFs that do pay out dividends, you'll definitely want to join that session. Okay, let's look at our last question. Is there a recommended monthly contribution if you want to realize a meaningful increase in your investment value, especially if you don't have a lump sum of 36,000 Rand? So that's an interesting question. So another flexible aspect of a tax-free savings account is that you can invest as little or as much as you want when you can. So you don't have to commit to a monthly payment. You don't have to do a minimum amount of sorts into it. If this month you've got 50 bucks, you put 50 bucks in. If you get 5,000 Rand for, I don't know, your birthday, or you get a bonus at work, you can take that little lump sum and put it in. So it also offers that flexibility as well. But any sort of, I don't know, not guidance, but tips for that. Is there a recommended monthly contribution?
Well, what I would say is that one of the big secrets to investing and saving is that one needs to start. And often we can get very hung up on making sure we make the right investment, which ends up becoming an excuse why we haven't saved, because we haven't found the right investment yet. But what's going to result in you achieving your savings goals is making sure that you save, regardless of what you invest in. So I think the most important point is just to start. And I think certainly from Easy's perspective, you've made it really easy and accessible for investors to save with whatever they have. There's no minimum. So that makes it super, it removes that excuse of, oh, I don't have enough yet to start. You can start with whatever you have. And I think that's the bottom line. Obviously, your money will then grow in line with the performance of whichever strategy you've invested in. So it doesn't really matter how much you put in. It's going to grow from a return perspective in line with that. But the more you can invest from the start and the more regularly you save, again, you put the odds in your favor of achieving your investment goals.
I like that. So I think we should end off there. Just start. That's the key takeaway from today, along with all the other cool stuff that we learned about the MSCI World. Thank you, everybody, for joining us today. Thank you, Kingsley. Thank you, Teaser, all the way in China. Thank you so much. And make sure that you do pop in, check out the webinars. They are on our YouTube channel, and they will be taking place again over the next few weeks. So thanks, everyone.